The discount rate is always one of the most important and most sensitive inputs to any financial model that you build. Let me show you how big of an impact it can have on your model by just changing a few things. So this is a reverse discounted cash flow for Nintendo. Now take a look at this sensitivity table. The base case, which uses a 10% discount rate, shows that the market is implying a 9.8% free cash flow growth every year for the next 10 years, baked into the price of that stock. But if you were to use an 8% discount rate as well, it's only 5%, which is super reasonable. But again, if you go up to 12%, it's showing a 14% implied rate of growth, which is a heroic amount and I think probably impossible for the business. So what is the right rate to use? It can be a little bit tricky. That's why in this video, I'm gonna go through the 5 levels of choosing a discount rate and how to think about it at every step of the way so that you actually understand what you're doing and are confident in your decision. So level 1 is the fixed hurdle rate. So this is a rate that you choose, and no matter what analysis that you're doing, you keep it the exact same. Every model, every investment, every analysis, you use the same rate. And this is based on a couple different ideas, but all of them come back to what's called the cost of capital. This is the idea that your money has a real and implied cost depending on how you use it. So for example, let's say you take out a mortgage to buy a home. You might have to pay 4% interest on that mortgage. That is your cost of debt for that investment in your home. I think that's pretty straightforward and easily understood. But the second component is what's called your opportunity cost. This is the idea that every dollar you spend has an alternative that you could have put that money towards that might have got a better rate or could have been lower risk. So for example, let's say you're looking at 2 different opportunities. Maybe one promises a 15% return and one promises an 8% return. If you choose the 8% investment, you missed out on 7%. That money you missed out on was your opportunity cost. And you have to factor that into the discount rate that you choose as well. And then the final piece of the puzzle of choosing that discount rate is risk, because you could buy government bonds with basically 0 risk, or you could invest in a low-cost broad market index fund that will probably return an annualized 10% every year with low risk but higher than the government bonds. All of these pieces matter when you determine your hurdle rate. That said, most people generally will pick a rate between 8 to 12% because, as we'll see later on, when you do some of the more complex analyses, it's usually bounded within that range. And so you just pick one that you're more comfortable with. Maybe you want to be a little more aggressive, so you go with 8%, or maybe you want to be more conservative, so you go with 12%. Neither is wrong per se. It's based on your own way of thinking, your time horizon for your investment approach, and ultimately a judgment call. The point though is that at level 1, you keep it the same. And there is genuinely nothing wrong with doing it this way. It has some very real benefits. For example, you stop thinking about the rate and you spend your time actually thinking about the business that you're analyzing. We all have limited time. So if you're able to cut down on the time you spend thinking about your discount rate and maximize the amount of time you're actually weighing the factors that matter in your head about your analysis, that's awesome, and a lot of experienced investors will just stay at level 1. The problem with the approach though is that in reality, your opportunity cost is not always the same. Let's say that you think your opportunity cost for any investment is that you just put that money in the S&P 500 and let it compound at an average of 10% every year. The truth is that the average valuation of the S&P 500 varies year to year, and your expected returns at different valuations might not be that 10%. So it's a little bit of a false simplification to say that it is. That is where level 2 comes into play. And this is what I call the macro adjusted opportunity cost. So like I said, let's say that you consider the S&P 500 to be your opportunity cost. This is the rough valuation of the S&P 500 since 1994. And whether you bought the S&P 500 down here or up here had a huge difference on your returns in the future. And as you can see, we are currently at a very high range of the S&P 500. So I don't know the future, but that might mean that the money you put into the index now is not going to return that 10% going forward. It might be less than that. That said, if you had bought the S&P 500 in 2009, your expected returns would have probably been way higher than 10%. So a higher opportunity cost existed for any specific investment. And yet the hard part is that timing the market is essentially impossible, and you should not try to do it. As we can see, the market has basically been in the historically high range since 2024. And even though in 2025 it did come back down, it just went right back up again. And frankly, the returns over the last year of the S&P 500 have been pretty insane at a compounded growth rate of 25%. So if you do want to use the level 2 approach, my advice is just to take the 8 to 12% band that we talked about before and only move within that depending on how the market looks. This way, if the market is running hot and it looks overheated in your analysis, you can use an 8% discount rate. If the market looks normal, you can go with a 10% rate. And if everything in the market is looking super pessimistic, you can go with a 12% rate. This keeps you within that reasonable normal band while still letting you make some consideration for how you feel and the direction that some of the key market indicators that you might monitor are looking. Now, like I said, normal people like you and me are probably not going to be able to predict which way the market goes. That's where level 3 comes in, and it's actually pretty simple if you understand level 2, but it does require that you do the upfront work needed to analyze the business before you start modeling it, which I would hope that you do regardless, but you do need to have done it. Basically, what you do at level 3 is you start at 10%, or maybe whatever you picked from level 2, and you adjust it based on business-specific risk that you identify in your analysis. So at a high level, maybe the business is in a very competitive industry with not a lot of differentiated products, or it's in the early stage of life. You might nudge that discount rate up a little bit. You might even go beyond that 12% if that's your starting point. You might go up to 13 or 14%. But if it's an established business, it has strong pricing power, it's a global brand, or it has a strong balance sheet, you might nudge it down a little bit because it's less likely that you're going to lose any money on that specific investment. Now, at this point, I think what we've talked about should make total sense and is genuinely pretty straightforward, I think. But in reality, it's not how any institution would do it or any real professional organization. And it's definitely not what you would learn in a textbook, for example. So that is level 4. That's what we're going to talk about here. Level 4 is called the weighted average cost of capital, or the WACC. And the idea is that every business is funded by two sources, debt or equity, the lenders who issue debt or the owners who provide capital in exchange for equity. And those two sources of capital have different costs associated with them. So what we do is we price them separately and then we blend them together to get that weighted average cost of capital. Now, I'm going to show you the formula, and be prepared because it's a little bit ugly. But let's start with the cost of debt. What you're looking at here is actually what we already talked about in level 1. All you're doing is you're taking the proportion of the business that is funded by debt and you're multiplying it by the interest rate that they pay on that debt, and then you multiply that by the inversion of the tax rate. So that's maybe a little twist to what we talked about on number 1, but really the only thing you have to understand is that your net income is what you pay tax on, and interest expenses are deductible against that. So you're able to remove interest expense from the revenue that you earn, and then you don't have to pay tax on it. Now, the cost of equity formula is a little bit more tricky. E over V is the proportion of the business's funding that comes from equity, similar to D over V. But RE, which is your cost of equity, requires another formula. And this formula is called CAPM, or the capital asset pricing model. Now, the way this works is that you take your risk-free rate. So that is the rate of return or interest that you can collect if you invest in long-dated government bonds. So you loan the government money for 10 years and they pay you interest on that, maybe 2% to 5%. And then you add that to this formula. So what this is what you as an analyst decide is what the market might return to you over that risk-free rate. So again, let's say that we use the historic average that the S&P 500 returns. Call it 10%. If your risk-free rate is 2%, then this calculation here would resolve to 8%. And beta is an estimation of risk. And what is used to estimate risk is the volatility of the given stock that you're looking at. Basically, how often it swings up and down and how severe those swings are. And you can just look this up for most public equity companies that you're looking at. Apple, for example, looks like it's about 1.1. The real benefit of this methodology is that it's rigorous, it's disciplined, and it's consistent. And to be totally honest, I think it just makes people feel better that you've gone through this process rather than saying, I think the market seems overvalued, so we're gonna go with 8%. But before we move on, I wanna ask you something. There's a major assumption in this methodology that is highly contested among investors. The problem is that it's using volatility in the stock as a proxy for risk. Have a think about that. Do Do you agree that's what risk is? To me, risk is the probability of permanent loss of capital, the risk that I'm going to lose money forever by making an investment. A volatile stock just means that the price goes up and down in big amounts pretty frequently. It doesn't have anything to do with the intrinsic value of the company. Like if this is the intrinsic value of a company, this would be a very volatile stock. But at the end of the day, this is a great investment that would be punished by the CAPM formula. And in fact, this volatility would actually probably be a benefit for a long-term investor. It gives you a bunch of opportunities to buy into the business at a low price and some other opportunities to get out of the investment if there's another opportunity that intrigues you at a high price and to make a good return. I don't think volatility really has anything to do with risk, yet this formula treats it as such. So like all the other methods, even though this is the most complicated, has pros and cons. But there is still one more level to talk about. So let's get to level 5. And this is the meta skill, which I've broken up into 2 different parts. The first part is that every analysis you do, just like what we did in the very beginning of this video, should have a sensitivity table attached to it. You shouldn't just look at what your model. You should look at the output of your model under a whole bunch of different assumptions, including variations in the discount rate. Because like we saw, under a high rate, the investment might look like a bad investment, whereas under a good rate, it might look like a good one. And really, I think what that means is that if your analysis and in essence, the decision you're about to make is highly dependent on which rate you use, it's probably not as good of an opportunity as you think it is. And you should probably spend a little bit more time either thinking about your model and whether or not you think it's correct, or passing on the investment entirely. And then the second part is something that you can do at every single level that we've talked about so far, and that is documenting your thinking. Regardless of if you go with level 1 and a fixed hurdle rate of 10%, or you go with level 4 and you do all the arithmetic required to calculate CAPM and to calculate the weighted cost of capital. You should write down why you're using the numbers you are at every given stage and the reasons behind your thinking. There's a rule for documentation that I learned when I was becoming a CPA, which is that for any work you do, any similarly qualified CPA should be able to come into that file and follow your work such that they would either come to the same conclusion as you or fully understand your reasoning process for the conclusion that you came to. And whether you're working for a business or you're just doing investment research for yourself, I think that you should follow the same approach because first of all, writing things down forces you to be logical and to really consider the steps of your thinking and your process. And then secondly, it means that you can come back and audit yourself and see where you were right and where you were wrong and ultimately learn to be a better analyst and a better investor and a better thinker overall. If you didn't write anything down, I guarantee you're either going to forget it or you might cut yourself a little bit of slack in how you judge yourself in the past. So after we've gone through all this, let me tell you what my personal approach is to this. At work, I just use the WACC that I'm supposed to be using, and it's calculated in the industry standard way using the CAPM formula and the cost of debt formula. In my own research, I typically just stick to level 2. I definitely acknowledge that I am not able to time the market, but I do like to stick to the belief that this time is not different. And right now, the market seems super hot. I don't know how long that will last for, but I'm okay to adjust my discount rate down to 8% or 9% because of how things look at the moment, and I will definitely be adjusting it upwards if things come down. That is where I feel the most comfortable, and it keeps things nice and simple for me to essentially use the same rate across every analysis and update it every 6 months or every year. But I also almost always use the level 5 approach of creating a sensitivity table. And I almost always find it instructive in my thinking for the analysis. A lot of times I'll see that the sensitivity of the analysis is too sensitive on either the discount rate or another assumption for me to really feel confident in the decision that I'm making. And then in terms of using the findings from my analysis in terms of how strong the moat is or the risks that it's faced, I don't like to factor that into my discount rate. I will use that to help guide my sizing or my conviction in the investment or the project. But at the end of the day, the discount rate for me is a measure of the cost of capital and the opportunity cost. And that is really it. So regardless, if you want to go with level 1 going forward or do all the work for level 4, I do hope you include a sensitivity analysis, and I do hope that you feel more confident in the decision that you make going forward. So thank you for watching. If you liked the video, you should watch this video over here and you should subscribe. So thank you for watching. See you later.